Afternoon. I want to thank Dennis and everyone here at Better Markets for pulling this together. He makes our jobs look easy, and I want to thank my co-chairs, Kate Judge and Simon Johnson, and then everyone on the Better Markets Academic Advisory Board for being here with us. I'm delighted to introduce this keynote conversation on private credit and public risk, which is our keynoters are Antonio Weiss and Mark Zandi, and moderating the Q&A section of this panel will be Adrian Keevil. So a little bit on Antonio Weiss. Besides the fact that I have known him, I don't know, since the Reagan era, I am honored to be able to introduce him as a former counselor to the U.S. Treasury Department under Barack Obama, under Secretary Lew. In that capacity, he oversaw domestic finance and helped restructure Puerto Rico's debt. Right now, he's a partner at SSW, but he spent 2 decades at Lazard, where he rose to the level of heading investment banking. Also, as a former English major, I'm most impressed by the fact that he was the former publisher of the Paris Review and the executive editor there. I'm also introducing to his left, figuratively, not literally, or literally, not figuratively, I'm sorry, or both, Mark Zandi, who is the chief economist at Moody's Analytics for the past 20 years. He was the founder of economy.com, which is, I think, how he got involved with Moody's. I was reading, he's author of this book, Financial Shock, a 360-degree look at the subprime mortgage implosion and how to avoid the next financial crisis. It would be good to know because we might be heading in that direction right now. Now, on Tuesday, you may have seen that Mark wrote a piece where he predicted that there was a 48% probability.
48.2.
Excuse me.
Yeah.
I feel like I can round. I don't know. Okay, 48.2.
Boy, you're testy. Yeah.
Luckily I'm not moderating. This is why they don't let me do that. A 48.2% probability that the U.S. economy will suffer a recession in the next 12 months. But speaking to what John said, the one thing that may help us is if the quote unquote well-to-do keeps spending. And so I'm wondering, am I considered part of the well-to-do? Because that way I can explain to my husband my future spending habits. We'll talk after about that. And the Q&A will be led by Adrian Keevil, who's an assistant professor at the Darden School of Business at UVA, where he teaches business strategy, business ethics, and also focuses on behavioral economics. Maybe we should talk about my spending habits as well. With no further ado, please begin.
Thank you.
Thank you, Jen. Good to see you, as always. I want to start by thanking Dennis and Amanda and the team at Better Markets. I mean, these are, I can say it, I'm self-employed, really terrible times. And the work that you do at Better Markets and have done for the last 15 years is incredibly important, just your focus on it and expertise. So thank you for inviting Mark and me to speak today. We're going to talk about private credit and systemic risk. And our comments will fit well with Commissioner Crenshaw's from earlier this morning, as she touched on public market participation in private assets generally. And private credit is really a case study for a broader conversation about the provision of credit to the economy by non-bank financial intermediaries, and the implications of that growing sector for financial stability. And that will be the focus of our comments today. Now, I promised Dennis that we would start with a quote from one of his favorites. So there are a lot to pick from. Jamie Dimon has had a lot to say about private credit over the years. He started a private credit fund, which is now part of BlackRock, but he has competed with it for the most part. In any event, last year he said, anything that's growing that rapidly, if you look at almost every financial crisis, it was financial products. Whether it's systemic or not, that remains to be seen. I don't think private credit itself is big enough to cause a systemic problem. Later in the year, he allocated $50 billion of balance sheet to private credit, and it's really booming, and we're going to go through the reasons why. So Mark was kind enough to ask me to join a team of economists, two from Moody's and one from, at the time, the SEC, Samim Gamami, who's SEC, and Damian Moore and Martin Worm from Moody's. And what we wanted to do was to provide a quantitative, in addition to qualitative, analysis of this question. It's hard to do. There's not a ton of data. That's going to be an issue we talk about. But Mark's colleagues came up with some techniques which were pretty illuminating. Now, I'm going to talk about the product, what it is, its growth, why it's growing. I'll highlight some qualitative reasons that we think, in addition to benefits, there are some systemic questions. And Mark will go through the quantitative aspects of this and provide some concluding remarks. I should say the questions we were trying to answer were, one, what is the level of interconnectedness of private credit players in the broader financial system? And two, what is the direction of spillover? And the analysis, despite the data limitations, should provide some reasonable initial responses. Now, private credit as a product is I'm just going to spell it out, people may know this, is a closed-end fund in general, locked up funds for 5 to 10 years, such that there's decent matching of the funds to the exposures. It is in a variety of areas. People think of it as direct lending. Direct lending is maybe 35 to 40% of the market, which is to small, medium enterprises mostly, and to buyouts. But it's also mezzanine, infrastructure, asset-backed, and so on. And it's really expanding into new areas. Most private credit firms are affiliated with an alternative asset manager. Those are, in the main, private equity firms. The largest ones are public. And the compensation structure of private credit, which isn't much discussed, is basically fee plus carry. So whereas private equity is in the range of 2% fee and 20% carry typically, this is about a 1 and 12 to 15% carry product. It's a floating rate product, I should point out. It's not fixed rate. It's typically priced off of SOFR, and the rates all in can reach 11, 12%. So it's growing. This is all non-bank credit, so it understates the private credit growth, which is at the top, the light blue bar. But private credit itself has been growing at 15% historically, and it really does lead the growth in overall provision of non-bank financial institution credit. And it's, as you can see in the 2025 column here on the far right, reached the same size as high yield bonds, exceeded leveraged loans in size, and that's a tendency that's likely to continue. In general, as I mentioned, these are locked up funds in general, and they are provided by long-term capital, pension funds the biggest, endowments and foundations. You can see the list, insurance companies who have obviously long-dated liabilities, and this helps them in matching. Most of these players are They have their own in-house credit teams. They're sophisticated, and they're well suited to hold this exposure. In the other column, there's something called business development corporations. Now, BDCs have existed since, I think, 1980, but they've really been growing because they're expanding into this area of private credit, and they're typically affiliated with the alternative asset manager who provides it. And they are either private or public, and the public ones are going to be the subject of our analysis because we have data on it. And that does involve retail, and we'll talk more about retail in a second. Borrowers like this. They like it because on the left you have survey data. I think it's from the University of Chicago. And if you start at the bottom, which are the biggest reasons, they get a quick answer. There's fast execution. There's higher leverage, so they can borrow more. They may say the covenants are flexible. They're actually a bit tighter than public markets, but because there's a stable lender relationship, there is syndication now. But in general, you've got one counterparty in the event you need relief. Maybe you have two, you have three, much more, and those counterparties can provide the kinds of modifications that are not as available with public borrowings or bank borrowings. On the right, you see the little bubble is the amount of leverage. Vertically, it's earnings. Horizontally, it's asset base. Because a bunch of it is asset-based, it looks relatively low by that measure. But if you look at earnings, this is typically being lent into more leverage than high-yield bonds and leveraged loans credits. Now, growth. The market is $2 to $3 trillion. If you listen to the largest players, they say that this could reach 20, 30, or $40 trillion. Pretty important to understand where that comes from. Private credit is already deployed into the areas on this page, but the share, if you compare the blue bar to the orange, I think it is, bar, is relatively low. And so there is increasing penetration in not just the historic mid-market lending sector, but areas of consumer finance, non-agency residential mortgages, specialty finance, and there's really no area that private credit cannot attempt to tap of traditional lending. Investment grade is a big area where private credit may grow really substantially. And this is despite the fact that the spreads it's more expensive. The spreads are greater than many of these alternative sources of lending. But because of the benefits I mentioned, there's a market with borrowers. Now, Commissioner Crenshaw talked about this. We won't repeat some of the things she said, but obviously the executive order democratizing access to alternative assets is going to, I think, likely open up private credit to retirement accounts, mostly retail. 401k is the biggest piece of the $12.5 trillion. And the chair of the SEC has said that he is actively revisiting the 15% threshold for liquid closed-end funds. What that means is that I mentioned sophisticated investors, well-suited to long-dated assets, can tolerate illiquidity. What it means is that there will be a deployment from this category of investor who are more liquid and do not have in-house credit teams to assess risks into this category. Raises a number of the issues Commissioner Crenshaw mentioned today, and it impacts the analysis of financial stability going forward. Just briefly, what are some of the benefits and risks from a systemic standpoint of this growing category. On the benefit side, it is an added source of funding to the real economy, undoubtedly. It has been and acted as an alternative channel in credit provision when banks pull back, as they did during COVID, and private credit was the place to go for credit. It provides diversification for investors. It does, in general, do a better job of matching liquidity and maturity than banks due to its funding source. As a result, there's reduced run risk. This is all up for grabs now that retail will be participating in the sector. And incentive alignment, you could put, frankly, in either column. There is the managers of of private credit funds do have their income tied to the loan performance. On the other hand, it's an incentive to grow this thing, which maybe we'll talk about in the discussion. And then the last is that you have at-risk investors. This is one of the main benefits private credit managers will point to, who are bearing losses. They know they're going to bear losses if they're losses, and they do. Risks. Boston Fed did a good report in the summer where they argued that if there was higher credit risk in the system, there was more systemic risk. This is sort of the flip side of the coin of being an added source of funding. Second, which is obvious, it's just not been tested in a downturn. And so there's really no visibility into how this sector will perform if there's a recession and so forth. It's a very concentrated sector, and there is limited disclosure to regulators and the public. This is why there's so little quantitative analysis, parenthetically. Regulators get, well, the SEC gets Form PF, whatever you think of Form PF. Bank examiners get the call reports, the Y14. The BDCs have to disclose to the SEC, and the public gets those disclosures, and state insurance regulators have some visibility. None of that's consolidated. I mean, but it exists in various pockets. The public only gets the public-facing SEC part of that. Valuations are opaque because it's the valuations, they're carried at a mark to model as opposed to a market price. A lot of discretion in mark to model. And that's against, even before this retail and retirement fund point, there's been a growth in semi-liquid funds. I think there are about 200 billion of semi-liquid funds that have some redemption characteristic. And then last is the interconnectedness with the regulated financial system, which is the subject of our paper. And I'll wrap up on this slide. How is that happening? So banks have often been characterized in the popular press as frenemies. They're increasingly participants. The whole relationship between banks and private credit providers is up for grabs at the moment. Some compete, some do it themselves off their balance sheet, some are in JVs or other forms of partnerships. Banks lend to the private credit vehicles through revolving lines of credit, subscription NAV loans, and there's not a ton of leverage documented, I should say, and it's senior, but it's leverage that's pro-cyclical, and I think you could ask a number of questions about it. They also invest above the private credit fund to the investors. Say there's a fund of funds that inject capital into a vehicle. Banks are also, particularly in Europe, transferring credit exposure into these funds, and they're also extending swaps. Insurance companies are largely integrated with private credit providers into captive insurers, and that means that there's, even though separately managed accounts, there is the potential for conflict of interest, obviously, if you're generating it and on-selling it to a related entity. And they invest in all sorts of ways into the funds. They hold loans on their balance sheet. They're in CLOs, which is a growing part of private credit. So private credit being syndicated and on-sold. And there's this thing called a funding agreement back notes, which if we have time after, I'll address, but I'd like to pass it to Mark.
Great. Thank you, Antonio. Thank you, Dennis, for the opportunity. It's a pleasure to be here. I see Jared in the audience, Jared Bernstein, and do you guys remember we wrote a paper together, Jared, Antonio, and I? Jared doesn't remember.
Too many
He literally doesn't remember.
Too many papers.
Employee retention tax credit. Yeah, right in the middle of the pandemic. Remember that was a good paper. That was a really good paper. Yeah. No one paid any attention, but yeah. And actually, the ERTC is much maligned these days, but we should revisit. But thank you, and I'm going to do three things in my remarks, and I'll keep them short. One is just to give you a sense of what we did in the study that Antonio referred to, and there's a lot of detail in the study. If you want to read it, you can go to Zandi, private credit, systemic risk, and you'll go right to it. I highly recommend you take it and put it into Notebook LM. That will help you understand all the things that are going on, all the moving parts there. But you'll get a lot more detail there in that report. And then it was as Antonio was alluding to, it was took us a while. It took us about a year to get it all together because of the data limitations that are involved. And I think that's a big part of the story here. Is we need transparency around this market to really gain a better understanding of what's going on. And we work hard to address those limitations caused by the lack of transparency, the lack of data, as best we could. And the results that we got, and you'll see, and I'll give you a taste of it, is that the private credit has become more systemic in recent years. Show you how we come to that conclusion, and that it's playing a more central role in the financial system. The shape of the financial system has shifted from where it was in the great financial crisis, from a bank-centric hub and spoke system with the banks in the middle and everyone else around the periphery, to more of a web with private credit more central in that web. So it's played a very key role. It's playing a very key role in the system, increasingly so, and it's much more central to the system. But again, the paper will make that clear. Just a little bit of table setting. We did use we did look at the two measures of performance across financial institutions, and in our study, we had approximately 60 different types of financial institutions, equally broken down into the banks, mostly systemically important banks, SIFI banks, insurers. So obviously J.P. Morgan, Bank of America would be in the data, and insurers. So kind of MetLife would be a good example of that. What we call other non-bank financial institutions, NBFIs. That's everyone from Schwab to State Street. Those kinds of institutions. Not Rocket might be in there in terms of non-bank mortgage lender, and then the BDCs, the business development corporations, companies, and we're using the BDCs as our proxy for private credit. Now, I will say, as part of our work producing the paper, we did get a lot of input from folks in the industry. Obviously the folks at Moody's are very interested in this. They're paying a lot of attention to private credit. So some of the biggest players in the private credit space reviewed our research in our document. And really, I came out of that thinking I'm pretty happy with the paper. Given the critique, the most significant critique was that we're using BDCs as a proxy for the rest of the private credit, universe. And obviously we're doing that because that's where the data is. But we feel comfortable that the BDCs are, if you look at the private credit universe, kind of at the top of the stack. I mean, it's a higher quality. It's below investment grade, but it's at the top of the kind of the below investment grade universe, and the rest of the private credit world is I don't mean to overgeneralize, but generally of lower quality than the BDC. So the BDCs are, I think, if we're going to do this kind of work, is actually quite a good proxy for doing it. We have, as you can see, we have data back to 2004 across all these institutions. One other quick note: we looked at two forms of performance. One is just simply stock returns for these institutions. The other is expected default frequencies, EDFs. These are Moody's proprietary kind of measurement of the probability of a default as determined by the marketplace. So kind of a Merton model kind of structure. Looks at the value of the liabilities of the company, the assets, market value of the assets, and the volatility in the market value, and uses that to construct an estimate of the PD, the probability of default for that institution. So we looked at both those things. What I'm showing you here is the variance in stock returns across the four different sector types that we looked at. This is monthly data, and the last data point is through December of 2024. This is obviously a very good, historical period to look at. We've got two very clear stress periods. One is the Great Financial Crisis, GFC, back in 08, 09 into 2010, and the other is the pandemic in 2020 going into 2021. And you can see if you go back to the GFC, it was really the insurers and the banks that experienced the most volatility or variance in stock returns in that stressed environment. BDCs were much less so. But the obvious point in the chart is take a look at what happened in the last stress period during the pandemic. It's the BDCs whose stock volatility's variance has been much more significant and suggestive that they're much more systemic than they have been in the past. You will note in 2023, obviously in the middle of that year was the banking crisis, SVB and First Republic. It didn't show nearly as much stress, probably because the Federal Reserve stepped in quickly to quell that crisis. And you can see the banks really didn't experience a significant increase in volatility, although the BDCs kind of led the way again. It's not shown here just because I didn't have time to include it, but we do have data now through the first half of 2025, and you see a similar kind of spike in volatility with the BDCs leading the way in the period around Liberation Day, back in April when the president announced some very significant tariffs, and that created a lot of market volatility. So point number one is that the BDCs are much more systemic than they have been in the past, and increasingly so, and arguably, according to the analysis, more so than other financial institutions. Second, the BDCs are much more tied into the market. A much higher share of the variance or volatility in stock returns is explained by the variation in the market. And again, in stress periods, this is much more important. I'm showing the percent of the stock return variance in each of these sectors that are explained by overall market variation. For the technically careful folks, this is based on principal component analysis. This is the first principal component of that PCA analysis. And the intuition here is pretty clear. You can see the direction of where BDC, the first principal component, was back in the financial crisis and where it is today. And only the banking sector has a higher, a stronger relationship with broader market forces than the BDCs at this point. So, a very clear indication again of the systemicness, or the rise of the systemicness of BDCs. I'm using BDCs, and again, I mean this as a good proxy for private credit. But just to be more precise, I'm sticking to the words BDC. Finally, in this part of the conversation around the paper, we did do an assessment of the kind of interrelationships between financial institutions, looking at the relationship between stock returns and EDFs from one institution to the next across all institutions, using, again, for the statistically minded Granger causality. And this is kind of a cool way, at least from my perspective, of giving you a sense of what the financial system looks like and the interrelationships in the system. Each circle represents a node, an institution, and if the node is, or the circle is larger, then that institution is playing a more central role in the system. It has more statistically significant relationships through stock returns and EDFs with other financial institutions. The red nodes, circles, are the large banks, and you can see if you go back to 2009, that's the first web to the left. The banks played a much more the nodes were much larger and they played a much more central role. The rest of the system was a kind of periphery to it, not completely, but mostly. One interesting, again, from my perspective, thing is we actually have names attached to each of these circles, so we know exactly who they are, and it varies over time. But the one thing that stands out is that Goldman Sachs is always on the periphery. I don't know how they do it. They're literally always on the periphery, always on the periphery. Take a look at 2020, and of course it looks quite different. And this goes to the point I made earlier that the system now feels much more like a web. Now, there's a benefit to that that I think that is intuitive. Conclusion is that the system is probably better suited to digesting more gracefully modest shocks to the system because the system is more distributed and the risk gets distributed throughout the system more significantly, much different than back in the GFC. But it does lead to the concern that that the system is much more vulnerable to a major shock, because if a major shock comes along, then that shock will propagate throughout the system, and we'll see problems much more significant. And it's unclear how policymakers would respond to that. If you go back to the GFC, it was pretty clear what you had to do. Well, nothing was clear, but it was clearer that you had to backstop the banking system to backstop the financial system because it was more hub and spoke. And in fact, in my mind, the single most important policy response to the GFC was the day the FDIC guaranteed bank debt, because on that day, creditors knew exactly where the government stood with regard to that backstop. Spreads came in, TED spread came in, and the system started to come back to life. But in a web-based system, where do they enter? How do they enter? Exactly how does that work? That's an open question. Okay, part two, and I'll move along very quickly here because I know we want to get to questions. I've got a bunch of slides. I'm not going to use them. They're yours. I think if Antonio's okay with us distributing the deck, okay. I'm a macroeconomist. That's what I do for a living. And I want to identify two macroeconomic risks that are top of mind for me. And I'm not sending off any red flares. I'm not even sending off yellow flares. I'm just saying, we need to think about this, more carefully. The first is that non-financial corporate debt is now been increasing pretty significantly, and the debt to GDP ratio. So if I take all non-financial corporate debt outstanding, obviously the private credit is playing a lot of different sandboxes, but the most important one is the middle market lending to non-financial corporations. That if you look at that relative to corporate GDP or corporate value added, it's risen very significantly, and now it's quite high. It's about 100. It's almost 100%. Interestingly, just a sidebar, if you look at household debt to income, non-financial corporate debt to non-financial corporate GDP, or the federal government debt as a share of publicly traded debt to GDP, they're all 100%. They've gotten there in different ways, but they're all 100%. But the direction of travel for non-financial corporate debt is extending. Now, I'm not overly concerned about it in the sense that there's been a long-running increase, for lots of different reasons for that ratio to increase, just a expansion out of the availability of credit to different types of non-financial corporates, kind of a democratization of the availability of credit. So I'm not overly worried about it, but I do worry about the tails of the distribution. And this is the lesson, in my mind, from the SVB crisis, that if you looked at the kind of the median and the means of the of the capital ratios for the banking system, or the return on equity, you look at that, you go, no big deal, there's no problem here. But then you go look at the distribution, you go, oh my gosh, what happened? We got a problem here. And that's how I feel about the non-financial corporate sector, particularly in the context of private equity and private credit, because they're playing in that part of the distribution, and that's where the leverage is higher. And so far, they've been able to navigate through, because the economy's been fine, right? There's been no problem. Interest rates have gone up. That's caused some indigestion, and that's resulted in some of these workouts and distressed exchanges and PIK deals and that kind of thing. But that doesn't lead to corporate bankruptcy. That's when you got a real problem. But what would happen if with the economy actually does stumble and the sales of these companies actually started to go negative as opposed to exorbitantly positive? Then I worry about that. I think that's something we need to think about and consider. The second macro issue is monetary policy. There are a lot of cross currents here. There was a great paper that was put out by the Federal Reserve on this issue. And my intuition is that the availability of credit that's being driven by private credit is making it more difficult for the Fed to conduct policy, particularly in an effort to, if you go back to the recent episode with the Fed trying to raise interest rates to slow things down, cool things off, one of the major transmission mechanisms is via the banking system and the availability of credit. And of course, the banks did tighten down. If you just go take a look at the senior loan officer survey data for C&I loans, you can see it, as they tightened down. But at the same time, the PCs, they eased. They filled the void and then some. And so the availability of credit never really stumbled. It was there. It was available. So it makes it a little bit more difficult for the Fed to accomplish what it needs to accomplish. Now, as Antonio pointed out, most of the PC debt is adjustable. It adjusts very quickly, so interest costs rise. But I would venture that the companies that are getting PC, they don't give a damn about the interest expense. These are mostly healthcare companies, private tech companies, and they're growing really fast. On the margin they'll care, but that's not going to stop them from going out and borrowing. And so my sense is that monetary policy officials really need to think about what all this means in the context of the conduct of monetary policy. Finally, and I'm going to I'm not even going to go into this. We can talk about this in the Q&A. There are a number of potential policy recommendations that we put forward in the paper. Very light, nothing concrete. We didn't do any cost-benefit analysis, and Antonio makes a great point that we need to do that kind of work to be able to feel more confident about the proposals we're making. But some of this is pretty obvious in the context of everything I said. So with that, I'll stop and turn it back to the group.
Thank you, guys. Really appreciate that, and I'm going to do my best not to sound stupid up here on this stage with two very accomplished people who have been participant in the economy in very profound ways. You obviously, as a macroeconomist, and some might credit you with having been one of the first to raise a flag in 2005.
But you can come to any of my talks. I'll take it. I'll take it. Thank you.
And Antonio,
does everyone believe that?
Absolutely.
Okay.
It's famous.
Yeah. See, Jared's like that. Yeah.
And you've been humble about it too, which is very, which is unique. And Antonio, having worked at Treasury, restructured Puerto Rico, which was extremely complicated, and then also having run a large global financial institution, your guys' perspectives on this issue are really valuable. So thank you for coming. I guess the first question I had is sort of a basic question, which is, given there is a financial system, there are banks, banks are trying to grow, they're trying to compete. How is it that this asset, it's not an asset class technically, but let's just call it an asset class for nomenclature. How is it that came about? How are we here? How is it that private credit is even a thing?
I'll start on factors. It's definitely the case that financial regulation is a part of the story, but it's not going to be maybe even the primary reason. In as much as some banking activity did migrate, we could debate that, out of the regulated system. But it's also about innovation. It's about the fact that private equity firms became listed, that when they became listed, they needed new avenues for growth. It's about the innovation of combining insurance companies with alternative asset managers, which creates this channel that I mentioned. And it's also about, it's a very attractive financial reward, to put it that way, for growth. based on the compensation system and the like. And there's demand for it. I mean, I think it's impossible to disentangle all of those reasons, but they all kind of have fueled it.
I guess I would put a higher weight on regulation, bank regulation post GFC. Capital levels have been increased quite significantly, and I think there's a capital arbitrage that's going on. And to some degree, the banks are still playing because they're lending to the private. I was at a dinner with the clients of a very large financial SIFI institution, and talking to the fellow who kind of runs a big part of that organization. And he was saying, we're very aggressive in the PC market. We're extending a lot of credit to the PCs and non-bank financial institutions more broadly. It's not just PCs, it's non-bank mortgage companies. It's a lot of stuff going on, and then on the less regulated side of the financial system. And it just makes sense from them from an economic perspective, right? Given the capital, given the liquidity, it's just easier and they feel more secure, because of the way they're lending to the non-bank institutions are structured. They feel like they have, more collateral and they're in a better spot. So it's economics, it's just the lending goes to where it's going to be cheapest to create the loans. And private credit's done a really good job. And of course, now things are taking on a life of their own. And, because it's now become an asset class that's on everyone's radar screen and it's done well, you can debate how well after fees and everything else, but it's done reasonably well. Everybody else wants in. It's just, that's just natural. That's the way it works. And then, the regulatory environment's changing, the legal environment's changing, with the move towards retail. And so that's the dynamic that's now starting to come into play. And then I'll say, there's a lot of interest from other financial institutions with balance sheets with trapped liquidity, right? Like I'm on the board, I should have disclosed, I'm on the board of MGIC, a mortgage insurer. And, I can see that world really, the insurance industry really well. And, they've got a lot of liquidity and they feel like the PC market, matches pretty well with that. And so it makes a lot more sense than other types of investments they can make. So, as Antonio said, it's not one thing, it's a boatload of stuff, but the direction of travel is pretty clear. By the way, I've got my own way of saying what Jamie Dimon said, and I don't mean this to be pejorative in any sense. I don't mean that. It's just kind of cute, or I'm trying to be cute. With that as caveat, if it's growing like a weed, good chance it's a weed. That came from a CRO of a major bank back in the day, a credit card company that's no longer with us. Yeah.
Oh, interesting.
I agree. And I agree with everything Mark said for the most part.
That's great.
And we argue a lot, so I'm taking
actually
that,
like
man.
that's surprising. So do you think as it grows, as any asset class grows or any markets are competitive, capital is fungible. Do you see signs of weakening? Because right now, or at least up until now, the promise has been sort of less risk and more return. Right, you're senior in the capital structure theoretically, and you're clipping a larger coupon or interest payment than you would if you were going through a bank or through the normal capital market. So that's awesome. Maybe forever, if the entity or the corporate entity or the project, whatever is being funded, is okay paying more for more convenience, and investors are happy to take more money for senior risk. That sounds good, right? That sounds like that's okay. Do you see signs, or are you concerned at all about, as it grows and there's more competition, that lending standards start to decrease and maybe the returns start to go down? That sort of...
Yeah, I mean, Mark actually has a chart that shows, I don't know if it's in this paper, in this slide, but it shows the level of PIK exchanges, pay-in-kind exchanges instead of interest payments, that's been on the rise. And I think you make an important point, Adrian, which is that not all players are the same. When there are problems and stresses, they're often propagated from, new entrants, more aggressive terms, less rigorous credit underwriting. And I think there's reasonably good evidence that that's happening to a degree right now, and that's without recessionary pressures.
And then we're at 3 trillion, maybe going to 25 trillion potentially. Okay. I'll take some questions from the audience. We'll get the microphone over to you.
So it's interesting to look at high yield bonds and leverage loans as another indicator, because as you said, it's really a three-part market. And from my perspective, we've had 4 major downturns. First, the early 90s, when the LBO, Milken, Drexel Burnham thing blew up. 2000, 2002, when the telecom dot-com thing blew up. 2007-09, when the GFC came. 2020. I mean, if the Fed had not bailed out fallen angels, you saw the BDC spike.
Yeah.
If they hadn't bailed out fallen angels, the whole high yield market would have fallen apart. So what did the Fed do? They cut interest rates close to zero all 4 times. And I would say that the cut they made in 2002 brought on the subprime crisis. He cut interest rates, Greenspan cut them to 1%, and the subprime market took off. And 2007 and 9, 20. Then they had to do quantitative easing twice, and we've never gotten out of it. So we've had 4 experiences with this market, and they've all been horrendous. Why would we think that the 5th one wouldn't be as bad or worse?
Go ahead, Mark.
Okay. So to paraphrase what you said, you're saying all the dynamics are coming into place for the 5th crisis in this period of time that you've articulated. I think we should be wary and concerned of that possibility. Absolutely, yes. The direction of travel, if it continues, would suggest that at some point down the road, we're going to have a problem. We're going to have a problem, particularly if we don't change the oversight and the regulatory environment in which this part of the system operates. Absolutely. But, that can take a long time, and lots of things can change, and we could find our way to better regulate. Doesn't feel like that's likely in the near term, but, we may. It's still a small market. It depends on who you're listening to. I heard a number 3 trillion. I saw that came out from AIMA, I believe. I think in the U.S. middle market, Moody's estimates closer to $1 trillion, $1 trillion. Okay, $1 trillion. It's not nothing, but it's it's not. It was subprime mortgage. Circa 2007 was 3.5 trillion, and that was a much smaller economy than it is today, right? So, it's order of magnitude, but the direction of travel absolutely, makes sense. And I half joke, but only half. I think the reason why we have financial crises with that kind of regularity is because the people who lived in the previous crisis die and no longer run the companies that went through the crisis. I lived through the GFC. It affected my thinking about almost everything and will always influence my thinking going forward. But the young folks that are behind me, they go, what was that? And by the way, I've got AI, so I got better models, I got better data, and that's why we go down the same path. But we don't have to go down the same path. It's not inevitable. We've got to do things differently than we have historically.
I would just add one point. I think that if private credit goes, I think you're going to see massive problems with both leverage loans and high yield bonds. So I think then you're looking at more like a $5 trillion market.
Well, can I say though, in that regard, I mean, if you add up, and roughly speaking, leverage loans, high yield debt, bonds, and private credit, we're at 5 trillion out of 15 trillion non-financial corporate debt. And high yield has gone nowhere in about 10 years, nowhere. And that is in part because PC and first leverage lending through CLOs, and then PCs eating their lunch. So to some degree, you're having substitution here, right? It's not just, it's not just adding to the amount of debt outstanding.
Let me just make a broader point, because I see Sandra in the audience. If I were back at Treasury, more importantly, if Sandra were back at the FSOC, we'd be looking at a whole set of things. So just to underscore something that Mark said, risk is present in the system, not just because of how it's evolving, but in how it's being monitored or not and supervised. And if you listen to the current Treasury Secretary, the concern he highlighted was that this shows that banks are too regulated. So it's actually what he said. So we know that there are insufficient data. We know that the FSOC is not being used to monitor sources of future potential instability, that the OFR, which has substantial subpoena authorities in this area and could collect data, is not doing so. And in addition, everything out of the markets regulators is to liberalize the factors which would support this growth. And out of the banking regulators is to weaken capital and liquidity standards. So again, at the FSOC, I'm sure no one would say private credit is it. There'd be a whole set of things that could set each other off. But that mindset is largely absent in what's happening today.
There's a question in the front. Oh, sorry.
John Donenberg also mentioned systemic risk a couple of times, and I think you've mentioned that here too. Given the way this market structure is transforming, we really don't understand. It's untested. We don't know what kinds of linkages there are and what kinds of reactions we would get from the new players as well as the traditional players. So in a sense, when you talk about evidence-based policy making, this is really a battle of narratives, how we think the system might react, because we can't really preemptively provide evidence that systemic risk may manifest in particular ways. So the question is, how do you create a narrative which will actually make FSOC or other regulatory agencies believe in this possible narrative?
Let me take a crack.
Start now, continue.
Okay. I think one very useful tool to that end is stress testing. And I live in the stress testing world. You know, much of my work at Moody's is building the models and producing creating the data, producing the forecasts, doing scenarios for large financial institutions around the globe. And also for accounting purposes, CECL, IFRS 9, loan loss provisioning, that kind of thing. And it's an imperfect tool, but it's in my mind, a very useful tool because it makes people really think about how things work and go out and try to measure it and estimate it, and model it, and use it. There's all kinds of potential different pitfalls that people get trapped into, regulators get trapped into, but I think that, in my mind, is the best way of trying to address this in a systematic and quantifiable way.
And that's the direction the ECB is going in.
Yeah.
Which creates another level of complexity. International regulators viewing this differently than we are, and how that all sorts itself out.
I wasn't trying to sell my business. Although I did a pretty good job at it. Yeah, I thought.
I know your study was focused on systemic risk implications of private credit, but I wonder if there's another aspect of the rise of private credit that we're missing related to political economy and democratic governance. Are you at all concerned that shifting credit allocation decisions out of the regulated banking system into private credit? We've gone from regulated banks that are either large and publicly owned or small and locally owned. And now we're making credit allocation decisions in private credit that are opaque, largely concentrated on the coasts, not geographically dispersed, not subject to Community Reinvestment Act rules that would require a more equitable allocation of credit. Is there a broader concern about political economy, separate and apart from the systemic risk issues that you've identified?
I think those are fair points. I also want to be clear that we're not painting all private credit actors with the same brush. I mean, just to go back to what we said about the propagation of risk, typically comes from players who are less excellent at some of the aspects of what you say. But certainly, there's no CRA for private credit. There are no evolved supervisory protective mechanisms for individual borrowers. It's at a much earlier stage.
Thank you. Thank you very
Hey,
much.
thank you. Thanks for everyone. Thank you.